Dow Theory. To understand Dow Theory is to understand the birthplace of technical analysis. In 1882, Charles Dow and Edward Jones formed the Dow Jones and Company. Out of this company, and more importantly, out of the mind of Charles Dow, came the theories that formed most of the basis of technical analysis today. In 1884, Charles Dow published the first ever stock index, the Industrial Average, consisting of 11 companies. In 1897, Charles Dow created a rail, or what is now known as the Transport Index. In 1928, the Industrial Average grew to 30 stocks, the famous DJ30. And this is how it still stands today. I learned Dow Theory later in my career and wished I'd learnt it earlier. It's so powerful and puts market analysis into perspective. He was indeed a gifted thinker. The theories of Dow boil down to essentially 6 tenets. What we will discuss now and the descriptions you will see are simplified for readability from the actual text of Charles Dow. You will need to get copies of the articles he wrote in the New York Times if you want to see the originals, as he never wrote a book, he only got published in the famous newspaper. Having created the very first stock market index, Charles Dow was able to deduce the following ideas. Firstly, the averages discount everything. Charles Dow asserted that the market participants discount everything, including past information, present information, and future expectation. Also built in to the market stock prices are emotions, fads, and trends. And this was very much a new idea back then. Dow also asserts that the market has 3 trends. Up, this consists of prices making higher highs and higher lows. Down, meaning prices making lower highs and lower lows. And sideways, no major new highs or lows. He also says that each trend has 3 moves. The primary move, which is the major directional move, he compares this to the tide of the sea. The secondary move, which he likened to the waves of the sea, and the minor move, which he compared to the ripples on the waves. This is a fascinating analogy because it has huge meaning in understanding the market. The tide is fairly predictable. We know the times of the tide and more or less the distance the tide moves in any direction. The waves can vary in size, but they depend on the movement of the tide for direction. And the ripples on the waves are essentially a chaotic, unpredictable movement that has no real effect on the overall movement of the oceans. Now here you can see I'm displaying a chart which should help you visualize the ocean. This is a chart of the Dow Jones Industrial Average from the early 80s through the end of 2009. Now, according to Dow's description, of course, this is my interpretation, but you can see here I've marked some of the primary uptrend moves. So here, 1985 to 1987, there was a primary uptrend, a primary move, and you could see this as being part of the tide. And here, 1987, as we all know, the stock market crash back then was a primary move downwards and the tide was moving downwards. Here again, throughout the 90s and even an acceleration towards the end of the 90s, we saw a huge uptrend, a primary move according to Dow, which represents the tide. But to get more granular here, you can see I'm showing the waves. So you have the main tide moving upwards, but waves lapping backwards and forwards on the seashore. Also, you can see here the primary change in sentiment and market direction at the top of 2000, going through to 2003, when the recovery was finally beginning to take hold. Now we can see a primary uptrend resuming throughout the early part of the 2000s, all the way through to 2008, where we have witnessed the primary downtrend. The tide was moving back down. And here you can see we're starting to witness a recovery again. So you can visualize the market as the tide, the waves and the ripples. Dow asserted that the ripples were essentially chaotic and random. The waves essentially depended on the strength of the move of the tide. So primary, secondary, and minor moves. Now, what is exceptionally interesting is that Dow asserted that major trends have 3 phases. And what is fascinating about that is, as we move back to the chart I just showed you, he asserts that there are 3 phases: an accumulation phase, a public participation phase, and a distribution phase. This is very important because this stands true to this very day. The accumulation phase is when the informed buyer or the far-sighted investor sees that opportunity ahead is positive. The business climate is changing and there is strong value in the marketplace. They begin to invest. So if we look here, we can imagine that the accumulation phase of the smart investors who get in at the beginning of the huge bull market advances would perhaps be in this area here, this area here, in the early 90s, for example, and in the 2003 time area, and from March 2009 onwards, when the market bottomed. This, you could assert, would be the area of the accumulation phase, where the far-sighted, smart money is getting into the market at the bottom. Dow also mentioned the public participation phase. This is where the general public sees that the market is going up, the crisis has been aborted, and things are starting to look positive. The public starts to invest. Now, if we bring that into recent context, we've just had the accumulation phase. At some point soon, the public participation phase might start kicking in. We can assume that once the unemployment data starts improving, unemployment starts dropping in the US and in all the other developed countries with a lot of debt, and they start clearing up, then you can imagine that the public's view of the stock market is going to improve. And then more people are going to start investing in the stock market, and that's what's known as the public participation phase. Now here, if we look back historically, you can see here, let's say in 1988, 89, you can see there's a surge here. That could very well be public participation phase. And here, really up to 2000, there was a huge public participation phase in 1999. Everyone and their dog was trying to invest in the stock market. Everyone thought they would get rich off the stock market. And that was a huge public participation phase that I witnessed in my lifetime, when even your hairdresser or your plumber was giving you tips on hot stocks, and everyone was trying to get in on every new IPO in the marketplace. When everyone is screaming and ranting and raving about how they can make money in the stock market, then that's probably the top of the public participation phase and could essentially be the top of the market. So be very, very aware of that. Dow also discussed the distribution phase, and this is fascinating. This distribution phase begins while the market is going up, as the far-sighted investors begin to see that the economic climate is worsening, company fundamentals are weakening, and they sell into the rally. So, for example, if you look at the top of 2000, when the tech bubble really topped, the smart money realized that the expectations on the internet and tech stocks at that time were insane. The valuations were crazy. Companies that had never made a profit were being valued higher than some of the biggest companies in the world. And they had no way of measuring up. And once those tech stocks started to miss those expectations, the market crashed. Not just for those particular companies, but for most IT stocks and most of the market, in fact, in general. So as the market started to turn around, the distribution phase, the smart money, the far-sighted investors were selling into that rise in 2000. Something to be very aware of. Also, more recently, in 2007, 2008, the beginning of the slope of decline here. This is where distribution's starting to happen. No more new highs, and the market, the index itself, starting to drop, stocks starting to drop, because the smart money realized that the economic conditions for the market and for business were looking very unhealthy. Many companies were very highly leveraged, and credit was being severely restricted, and there was no trust in the banking or financial system. So people started to sell, and sell extremely strongly. And you can imagine the smart money and the far-sighted investor was selling into the rise in 2007 and 2008 as they knew this. This had missed most of the economists and academics in the world. You could see this was going to happen from the technical side of what was happening in the market. So that's where combining fundamentals and technicals is vital for us, and assessing market direction is absolutely critical for us. This is why I'm focusing on Dow Theory here, because you need to understand market direction, what potentially drives the market, and how to envisage how the market develops and moves up and down. The next of Dow's tenets are the averages must confirm each other. Now this is very interesting. Dow indicated that we can clearly see when a new bull market is in place, when both the Dow Jones Industrials and the Dow Jones Transports, the DJ30 and the DJ20, price has risen past a previous secondary peak. This graph should show you more or less how to visualize this aspect. So here you can see the Dow Jones Industrials, this purple line here, and here the black line, the Dow Jones Transports. So what he's saying here is both averages must confirm. Both averages have to start moving in the same direction to confirm each other. There is some background to that because the industrials rely on transports. So if the transportation industry to ship and move all these goods is working well, that confirms the fact that the health of the industrials is in good order. So there is some good economic background to this. So you can see here I've tried to map some potential areas where you can see there is mutual confirmation both on the upside and the downside. And Dow said that the major bull markets and bear markets could be indicated by Dow Theory and by the fact the averages must confirm. So you can see here I've drawn a line, and where the two averages cross right here is essentially where both averages have surpassed a previous secondary peak. So here's the secondary peak in 94, and in the middle of 95 both have surpassed that. And that would indicate, in my interpretation of Dow Theory, a major bull market. And that bull market essentially continued up. You can see here there's a pullback in 1998, but then it resumed all the way up to 2000. I've also noted here in just at the beginning of 2001, there was a bear market flagged as the price failed to beat a previous secondary peak. And in fact, both started moving down below support levels here. And you can see that. And according to Dow Theory, again, in early 2003, you can see here both the averages confirming the price of the average beating a previous secondary peak, both here and here. And also then the bull market continuing up and reinforcing itself then later in 05, 06. And then here, most recently in mid 2008, both the industrials and the transports dropped below their previous secondary peak. This would have been an ideal place to be getting out. As you can see then, the huge drop that ensued after that. Absolutely vital. Now, some people talk about Dow Theory, but also complain that it gives signals too late. For example, this signal here in 2003, you can see that essentially happened after the bottom has been hit. Here at the bottom, right at the beginning of 2003, yet the bull market was only signaled midway into 2003. There are various analytical techniques that we'll use in future sessions so that we can refine selecting what market direction we're actually in. However, Dow Theory does form the basis of most of this in any case. Another point to note here is that when I do technical analysis, I don't always use the transports and the industrials as a comparison. I prefer to use the industrials, the S&P 500, even the Russell 3000. You can use any combination of the indexes that you choose, whichever you prefer. However, I prefer to take a broader look at the market in general. And we'll discuss, when we discuss advanced declines and new highs, and new low indexes, we can discuss more on this topic. However, the choice of which indexes you use to mutually confirm each other can be essentially down to your preference. So it's worth experimenting and finding out what works best for you. For example, if you trade in the UK, you could use the FTSE All-Share Index, the ASX, versus the FTSE 100, for example. Okay, the next tenet from Dow asserts that volume must confirm the trend. Dow states that volume should go with the trend, and most technical analysts hold this true to this day. Markets rise on increasing volume and fall on decreasing volume. Any significant drops in volume during a rising market means that the demand for stocks at the current prices are dropping. And lower demand means sellers may be selling for less, therefore price may decrease. Of course, Dow suggested this is not as important a rule as the previous stated rules. However, you will see in future chapters a whole area dedicated to volume analysis, and this is really a very detailed topic that we will go into, as it's vital for the technical analysis and trader to understand volume levels and what they really mean. So to describe and show you visually how volume might have an effect on the market, and does have an effect on the market, you can see here the very same chart. This is the Dow Jones Industrials and the Dow Jones Transports. Again, the same coloring, a magenta color and the black color for the transports. You can see the previous markings of bull and bear market starts here. But also along the bottom, I've plotted the volume for the indexes during these time periods. So as we mentioned, volume should increase in the direction of the major trend. So you can see here really from the bull market here, you can see a strong increase in volume all the way to this period. But then you can see here that volume is starting to drop off right here and increasing up again. And you can see here as the market prices start to drop, so is volume. And then at the start of this new phase of the bull market, you can see here, this is the 2003 start of the bull market there, after the 2000 crash right here. You can see essentially that we have an increase in volume that tracks the index itself. But you can see here from 2007, the volume's starting to drop off, yet the stock price is increasing. And what happens after that? We get a huge drop off in price to the bottom of the crash at the beginning of 2009 in March, where we had a huge volume spike. So you can see here volume does give us some general indications of potentially the power behind the rally. So stock prices are increasing, more people are buying, driving the stock prices higher, then you would expect to see more volume there. And volume is the buying plus the selling. And as stock price increases start to fatigue, you would expect that volume starts to decrease. So on to the final piece of Dow theory, which is a trend is in effect until it gives a definite sign of reversal. This essentially means that the direction of price move is in existence until it proves that it is moving in an opposite direction. Well, how do we know this? This is where the whole art of trend lines and support and resistance lines come in. We will deep dive into this subject in detail in a later chapter. Now you've taken the first steps to understanding the methods of approaching the market and have an appreciation of Dow theory. These ideas you will see repeated in more sophisticated methods in future chapters. But remember Charles Dow and the opposing camps of technical analysis versus fundamental analysis. The reality is that fundamentals have an effect on the technicals, but also the technicals have an effect on the fundamentals. For further reading on the subject of mutual interactivity between the two, it may be worth having a read of George Soros's book, The Alchemy of Finance. But do beware, this is a pretty tough read.